Okay, it's 9:02 a.m. I'll call a meeting of the Pension Review Committee to order. Roll call. Harvey Lewis, member.
Matt Barker, member.
David Rader, member. Brendan Vavrinka, Anchor Consulting.
Greg Williams, staff.
Andrew Murray, Bailey Gifford.
Kevin Fenelon, Bailey Gifford.
William Johnston, staff.
Okay, first order of business is the adoption of today's agenda.
Move the adoption of the agenda.
Second.
All in favor?
Dan.
Approval of the minutes.
Move the approval of minutes.
Second.
All in favor?
Aye.
Okay.
Move we
Now,
adjourn.
business.
Oh, no, that's
That was quick. I'm sure you guys will not be that quick, but the floor is yours.
Thank you. Right, well, good morning, everybody. Good morning to everybody online as well. Thank you very much for inviting us. It's great to be here in person. I think it's 3 years since we were last here. A lot of water under the bridge since then, obviously, but it's really good to be back in person, so back on the road again. Andrew and I will each make some comments, if we may, and leave time for questions, although please do jump in as we go along if something springs to mind, and we'll try and answer those as we go along as well. I'll cover a very brief Bailey Gifford business update, make some comments around performance, and make some general portfolio comments, and then Andrew will talk in a little more detail about some portfolio fundamentals and how we see the opportunity set right now. So if that works for you, I'll just jump straight into the Bailey Gifford update, and there's 3 points I want to make, and the top of the front of the handout. Firstly is that the Edinburgh office, which is our overwhelmingly main office, has been fully open for a while to staff and visitors now, so that's good news. And both Andrew and I and the department we work in we're in 4 or 5 days a week probably, and that's really important because there's a real value right now in face-to-face communication and discussing a whole load of issues. So that's good news, the fact that the office is reopened. Even more importantly, our investment managers are now back on the road, meeting companies, both existing holdings and potential new investments. So in the last few months, I've been out to, for example, Holland, Denmark, Israel, Italy, the US, Brazil, all over the place, meeting existing holdings and trying to generate new ideas for the future for the portfolio. And by and large, they're getting a positive message as well from the companies they're investing. So notwithstanding all the sort of gloomy headlines that we're all reading about, they're getting pretty positive messages from the stocks that they're meeting. And the final point on the firm is that we continue to invest for the future. And this year we're actually recruiting 14 investment graduates, 10 of whom will go on to our equity teams, 4 into our multi-asset and fixed income teams. And they'll spend the first 5 years of their career rotating around various investment teams in their training period. So that's something we do every year. We recruit a bunch of graduates. Typically it's 8 to 10, obviously it's a little more this year. And these, we hope, will turn out to be the real strong investors for the future, much later in their career. So investing for the future. So all that is basically saying business as usual at Bailey Gifford. If you jump into, I'm going to ask you to jump around a little, I'm afraid. You jump to the back page or scroll down to the final page. If you're online, we've got some comments on performance, and you can see the sort of headline figures at the top of the page. And the long-term numbers since inception for you, of course, was July 2009, so that's a 13-year period. Inception and 5-year numbers are fine relative to the benchmark. But of course, over the last 12, 18 months, we've had a very poor period of performance, and we certainly don't want to hide away from that, and we want to be upfront about that, and I'll make some comments as to the whys and wherefores around that in a second. So short-term, some difficult performance. Longer-term, still performance ahead of benchmark. And then a little in the sort of centre of the page, you can see 2 lists. I would ignore the one on the left. That's a 3-month period, to be honest, and 3-month performance is just random noise. I think we all know that. It's driven by all sorts of factors, and none of which are to do with the long-term growth capability of the companies in which we're investing for you. 12 months is still a short-term period, but it's a little more meaningful, obviously, than 3 months. And on the right-hand side, we've listed the top 10 relative contributors to performance over the 12-month period. And in the greyed out block, the bottom 10 contributors, which are obviously bigger numbers because we have underperformed. And I think stock selection is overwhelmingly the reason for performance, good or bad, at Baillie Gifford. We are stock pickers, we construct portfolios from the bottom up, so it's all about performance of individual stocks. But I think unusually, over the last 12-18 months, there's been one overwhelming macro theme driving your relative performance, and that's the obvious one of the rise in inflation, the concomitant rise in interest rates, and the impact that has had on growth stocks in terms they've been derated. And particularly the higher growth stocks, what we would call the rapid growth stocks, also known in our language as disruptors. Then your portfolio has got quite a strong representation of high growth disruptive stocks. And these are the ones that have been battered, no other word for it, by the stock market over the last 12 months. So the top, the 10 stocks there from Zalando down to Wix, all did really well in 2020, but have given up most, if not all, of those gains in the intervening period. So Zalando, for example, I'm not going to go through the whole list, don't worry. Zalando is a European online fashion retailer that has been growing very rapidly, and of course when we were all working from home and locked down in Europe, everyone was online shopping, and Zalando did really well. Now things have opened up again. It still should grow, but less rapidly than previously. Mercado Libre is a Latin American e-commerce stock, but experienced similar dynamics, although that is still growing very strongly, and so on and so forth. So the rapid growth stocks are the ones that have done the damage for your portfolio. Some of them face shorter-term cyclical issues, I think, in the sense that the rise in interest rates around the world is going to have an impact on energy costs, and all these sorts of things that are in the news every day are going to have an impact on consumer spend. So there may be some shorter-term cyclical trading pressures for some of these stocks, but long-term, 5-10 years out, we're still believers in the growth potential of these companies. The final thing to say on performance is that we are acutely aware of the fact we haven't delivered for you in the near term, and that can create difficulties for you as a group and for your members. But the investment managers are absolutely focused on doing the day job, and we think the best way we can help you from here is for them to focus on the day job, which is identifying tomorrow's long-term winners. And if you had an investment manager in the room sitting here, I guarantee you wouldn't be able to tell if it was 2020 or 2022. They just sail on an absolutely even keel. They didn't get overexcited in 2020 when we were shooting the lights out in terms of performance, and they're not overly despondent now when performance isn't good. They're just getting on with the day job, the grind, the daily fund management work of just analysing companies and finding new ones. So that's performance. And then finally from me, just back to the front page, and again I apologise for jumping around a little. Just let me make one or two very broad top-down comments on the portfolio that you can see in front of you there before handing over to Andrew. First point I want to make is that we divide the portfolio up in presentation terms anyway, in terms of holding period. On the two left-hand columns, that's stocks held for over 10 years or between 5 and 10 years. So 57% of the portfolio has been held for more than 5 years and 25% for more than 10 years. So we talk a lot about long-termism, and that's it. That's long-termism in action. 50%, 7% of the portfolio held for more than 5 years. The second point is, and I alluded to it in the performance comments I just made, we think there's some great opportunities for long-term investors right now. The shakeout in share prices in some of these companies has been so severe that we think that presents really good entry points to add and to top up holdings, and Andrew can cover some of those in more detail if you wish, but those are the ones marked with a plus where we've added to. And the third one is that we have stuck to our regular transaction tempo throughout this period of underperformance in 21-22, just as we did in 2020 actually, when things were going really well. We're sticking to the long-term philosophy and process. There's no change to the way we run your money. But please don't confuse that for, lack of action or negligence or anything like that. The investors are still doing their required due diligence on all the stocks in the portfolio. They're continuously re-examining the investment case for the stocks in your portfolio. And one thing we did earlier this year, just as we did in 2020, is a financial resilience analysis of the entire portfolio, because it's no good talking about a long-term prospect for a company if it's not going to be here in the short term. That analysis uncovered 2 stocks that we thought needed a bit of capital, that both actually had capital raises in the intervening period, and we supported those. So never say never, and there's life is life, and there's always a potential for things to crop up, the unexpected, but we think there's a really good, solid, financially sound, well-managed growth portfolio there. And the final one for me is China, and I'm sure this will be of interest to you, of interest to most of us after all. Your portfolio has 18% exposure to China. The benchmark's about 10%, so you're overweight China. And China has, the exposure to China has been a good thing over the life of your investment with Baillie Gifford. So where we are now, we don't think it's uninvestable, far from that, to sort of comment we heard in some quarters, but we think the opportunity set will more than likely change. Your exposure to China has typically been in the big platform stocks like Alibaba and Tencent and Meituan. We think the growth prospects for some of the platform stocks has been crimped by the regulatory developments we've seen in China, but at the same time, other opportunities are coming through. So you hold a healthcare stock in the portfolio called Wuxi Biologics, and you hold an electric vehicle manufacturer called NIO. So we still think China has the ability to offer rich opportunities for growth investors, but it's likely that the mix that you see in your portfolio will change over time. I think I've spoken enough. I'll hand over to
What about the odds of them being nationalized?
Pardon?
The odds of them being nationalized?
These companies are sort of the Chinese stocks.
Yes.
I think it's unlikely, to be honest. I think the way that the Chinese authorities are going to deal with them, rather than spend the money, and it would be hundreds of billions of dollars to bring them back under state control, is to regulate them, and this is what's been happening. I think regulation is the route that they are choosing to control their
Would they buy them out or just take them over?
Well, theoretically they could, of course, but so my argument is, why would they spend all that money doing that when they can regulate them successfully, and they have been regulating them such that they're having to pay fines, they're diverting money to good causes, things like that. So I think that's an effective way for the Chinese Communist Party to do that. Hasten to add that you may, it's entirely possible that your thesis is correct. We don't have an insider in the Chinese Communist Party in the same way that nobody does. But it looks like regulation is the route that they're going to use to control these companies.
Thank you.
So I can pick up the threads there, and again invite questions as we go through. I'd like to kind of kick off by talking about some of the transactions in the portfolio, and then there's a few themes that we cover in the centre spread, as we always do, that are hopefully helpful in terms of illuminating how we think about things. So sticking to the front page on transactions, I'd say the headline in the summary would be, and as Kevin said, the pace of change here has been very consistent with what we've done in the past. Over the last year, it's been 9% portfolio turnover. That sort of 9 to 12% turnover range is quite typical for us. It demonstrates the long-term approach. But that activity has been, the direction of travel here has been recycling capital out of stocks that have typically held up better, well might be the wrong word, but have held up better, and pushing that capital back into stocks where we think that the valuations and the opportunity set are particularly attractive right now. And maybe just flipping directly to the question Harvey had about Chinese companies and Kevin's comments on China. One of the places we have been taking money out of over the last 6 months has been some of the Chinese holdings, so the ones that are most exposed to the regulatory pressure that the Chinese government is putting on them. Those companies where we think the opportunity for them to expand into adjacent markets was part of the investment case, and that's been a pressure has been applied to that opportunity or that ability. So we've taken money out of Alibaba, where we'd always hoped that they'd be able to transition from e-commerce into cloud, into other services. That transition hopes to be less likely. And in the same way, Tencent, again, a huge platform company with lots of data that we'd always hoped would be moving into adjacent markets. that's less likely. So Alibaba and Tencent have been trims and sources of funds over recent months. Likewise, we've also trimmed Ferrari, which is a holding we've had in the portfolio for a long time. It's a company we continue to admire. It's done well in relative terms, so we've taken money out of a stock that's held up. We have concerns there in the long term about their ability to transition from an internal combustion engine space to an electric vehicle space. But we think the management team are doing a good job so far, so one we're watching closely. But that's more been trimmed on the back of holding up well. So you can see these reductions with the minus signs. We've also completely sold out of a number of holdings, and in red at the bottom of the page you can see the complete sales, and that would be over the 6 months to June. So this portfolio we're showing you here, as a mutual fund, we can only show you the portfolio in writing at the end at quarter end. But to the end of June we sold Block, which is an American company that acquired an Australian company called Afterpay, which was the company that we invested in. So we sold it Block as it's an American company, and this is an international portfolio. Pan Pacific International is a Japanese discount retailer where the growth prospects we just thought weren't as exciting as we saw elsewhere. TAL Education was a Chinese casualty of the regulatory clampdowns. We talked about that last time we were speaking to you. At that point the issue was very fresh. We held on for a while and eventually sold that stock. But I'd like to highlight two other complete sales that aren't shown on this page. On the left-hand column of the table, Inditex and Stellantis are two stocks that have been held for over 10 years. So in the case of Inditex, we had held that stock since 2008. Stellantis, which is the merged Fiat Chrysler and Peugeot brands, we'd held in a portfolio since 2012. So some very long-term holdings there. We don't fall in love with companies forever. Eventually, when the investment thesis runs out, we will sell those stocks. So Inditex is the world's largest fashion retailer. Majority of their sales is offline in bricks and mortar stores. They were late to the party, moving online, and we just felt that others had picked up the initiative there, and that transition to online sales was a headwind for Inditex. So a very long-term holding there, exiting the portfolio. In Stellantis' case, they're actually operating very well, the integration and merger. But again, concerns about how that company will transition. Hi, John.
Good morning, sir. I apologize to everyone for my tardiness here.
Not at all.
You get that 920.
There's a handout on the page there, John. We're just going through some of the transactions. So they're the sources of funds, and we've been moving those funds into I suppose two areas. Some new buys that I'll get to, but we've been adding to stocks that we've been holding for a while on weakness, and you can see that with the plus signs. I'd say there's three criteria we've been using here. It's not a case of adding to everything on weakness. It's where the valuations look particularly attractive. It's where our view is different from the market, and it's where we've had the opportunity to do thorough research and in many cases meet management teams. So if you focus on the stocks in the kind of green column, the 2 to 5, there's quite a few stocks we've added to there. Spotify, we had the opportunity to see the CFO in April and the CEO in June, and we've made additions on the back of those interactions and confidence in the business. All of the stocks in the column there where you've got the Adyen, Spotify, Delivery Hero, Wix, we've added to. They've all fallen by 50% or more in share price terms over the last year. So these are really exciting opportunities to add to these companies where we've got continued conviction. We really feel that as much as the pain is very sharp right now in terms of what's happened to the portfolio and to your assets, this is the opportunity for us to be buying the shares that will drive returns for the next 10 years. We saw that after the great financial crisis. A lot of the returns that were generated over the last decade were made on the back of investments we made shortly after that period. So we're trying to be very rigorous and stick to our discipline about buying growth companies through this cycle. We don't want to become your value manager. We're looking for the great growth opportunities of the future. So I'll highlight three. Well, there's been a number of new buys. There are 3 new buys shown on the page. C Limited, which is a Singaporean-based gaming, e-commerce and fintech company that is particularly strong across Southeast Asia. 2 Japanese companies with new buy symbols are GMO Payment Gateway, which is a software facility that enables over the internet payment transactions, and CyberAgent, which again is a Japanese advertising and mobile games company. But the 3 I'd like to really highlight are recent transactions in August, and they just amplify the kind of growth that we're looking at here. So 2 of the new buys, Wise and New Holdings, are financial services companies, digital financial services companies that are attacking different parts of the traditional banking infrastructure, and another, Elastic, is a search company. Focusing first on the digital fintech companies, And I'd say all three of these companies are companies that we've been looking at for quite a long time. And we're taking advantage now of the fact that all three have seen their share prices come off 50% in the last year. So again, that point about this is the opportunity to really to buy the growth that's going to come through in future years. Wise is a UK fintech company focused on FX flows. We owned it as a firm when it was a private company. It IPO'd last year, so we've been looking at it for the last 5 years or so. Traditional banks transact FX for customers in a slow, expensive and opaque way. So Wise's USP is that it's fast, cheap and transparent. It's a digital platform, so they've got no real estate costs, very little staff costs. And they do FX by building liquidity pools inside countries. They've got a lot of data, they know exactly what directions currency flows in each market. So they build pools of liquidity inside countries. Money doesn't cross borders through correspondent banks. It's much cheaper. They attract retail flows through their Wise account, SME flows through their business platform, and they're actually taking business directly from banks who want to work with them now through API links on a platform basis. And last year they processed £76 billion worth of money, which was up 40% from the year before. So these companies have been sold off heavily, but they're growing fast and are very attractive. I'll be very brief on Nubank. It's a Latin American company, founded in 2013, 50 million active customers now, operating in 3 countries in Latin America, but they've got aspirations to cover the entire continent and broaden out into other emerging markets. And the third company that's been a new buy into the portfolio is called Elastic, and it's an enterprise soft search tool, which is different to the consumer search we're all used to typing into Google. This is a company that enables enterprises or other companies to interrogate their own data, and we all know that data is the new oil, and companies are amassing huge quantities of unstructured, complex data. Elastic enables companies to make sense of that and use it. So, they are the power behind Netflix and Spotify search tools. They are the company that connect drivers on Uber to ride-hailers, and they're working with Pfizer, T-Mobile, Cisco, Home Depot on a whole range of different interrogation systems. So if you think of data being the new oil, well, Elastic is the refinery tool that companies use to sort of refine that oil. So that's a bit of a cheesy analogy I came up with this morning, but it's hopefully helpful. It's an open and free software, which means that customers can start to use it very easily and tweak it very easily, and they monetize that through add-ons, consultancy services, and cloud hosting. And a final point I'd make about us having looked at it for a while and not bought it, we were worried about the threat from the cloud majors, the sort of AWSs, Azures out there, just subsuming or taking over or kind of copying Elasticsearch. And that threat's gone away, or appears to have reduced significantly. Amazon was a real threat, but then they've now become a partner and a source of growth because of the way that Elastic is, its proposition is proven very hard for these cloud majors to sort of compete with. So again, we believe the shares we're buying now will be the sources of growth over the next 10 years, but we appreciate the pain that buying these stocks at a cheaper price causes when many of them you've held over the last 5 years. I'll pause there. There's some content in the centre spread that we can go through that's helpful, but I don't want to go over the top in terms of details. I'd like to take questions that you've got if there are any.
I just have one about, I'm surprised to see Shopify as a positive contributor over the last 12 months. You got any context around how that happened?
Yeah.
Besides just great timing by somebody, I guess?
Yeah, so
that's actually that's a quirk of the way the numbers are calculated. It's a positive contributor because we didn't have it and it underperformed, so therefore not having it in the portfolio brought a benefit.
Okay.
And the benefit was 47 basis points.
So you sold it at some point? Is that what
No,
we're doing?
sorry, Kevin, there should be a marker there.
Yeah.
So
Cool.
there's a few stocks there with a
Like,
blank on.
Is
like
that-
Gazprom and Luke Oil, they're on
Correct.
the list. They're
Gotcha.
positive because you didn't own them. They're just saying they're missing all the last
It's a good question because you've highlighted the fact that there should be a little cross next to it
Okay.
to identify that. So thank you for pointing that out. Actually,
That's my fault.
A quick one, you mentioned about elastic, and I'm looking on the portfolio holdings I saw earlier, and I'm just scanning. Where is that listed on here? Is it not listed on your
Some
holdings?
more recent purchase.
Yeah, so
Is that in a separate?
as a fund, we can only show you physically the portfolio at quarter end.
Gotcha,
So
okay,
this
that's
is
in the
the,
country, okay.
so I was keen to bring you up to date with some of the more recent transactions
Yeah.
globally, but that's the portfolio as at the end of June.
Okay, fair enough, thank you. Thanks, Mike. All right.
I just want to ask about, you, obviously, 2021 performance was fantastic, valuations, you know, were elevated. So I guess my question is, now that valuations have certainly compressed, where does the portfolio sit maybe relative to, say, historic averages?
Pretty much in the middle of where it's typically been, to be honest. So we think that's a pretty decent starting point for now, having worn some pain over the last 12 or 18 months. It's back to some kind of long-term, longer run average of where it's been. Obviously, it's flipped either side of that over time, but roughly in the middle.
With respect to your Chinese holdings and just China in general, are you concerned, you know, with the perception of maybe, you know, restrictions on tech that are being put into place from the U.S. and things like that, like not selling them higher end chips and things like that? And then as an extension of that, the posturing over Taiwan, and do you see that developing into something that would, like, you know, create an actual conflict and really maybe have huge impact on their markets?
Do you have any holdings in Taiwan?
We've got TSMC, yes, indeed, which is a chip manufacturer, and it's TSMC, Samsung, Intel, are the sort of leading chip manufacturers in the world. TSMC actually is spending, it's building a huge plant in, I think it's Arizona, maybe New Mexico. It's spending $10–20 billion or something to put in a big fabrication plant there. So I think this is a sign of diversification of manufacture of these things, which will happen over time. In terms of the technological piece, William, I mean, I think, let me give you a stock example. ASML is actually the largest holding in your portfolio. It's the top of the grey column, 6.2%. It's a Dutch manufacturer of key equipment in the semiconductor manufacturing process. It's got a monopoly on what are called extreme ultraviolet machines. It etches, you know, nano-sized lines on wafers to enable chips to be manufactured. Incredibly high tech, and I think these machines come in at $250 million a pop. You know, so they're expensive pieces of kit. That's had to restrict what it can sell to China. But fortunately, in ASML's case, you know, the sort of its market position, having a monopoly at that end of the market, and the growth prospects longer term for the sort of chips is so overwhelming that more than offsets that.
Yeah, if they lose something in China, they're going to
Doesn't
gain
matter
more
to
than
them.
that somewhere else.
Exactly. On the will they invade Taiwan bit, I guess that would be I think we would view that as a low probability, extremely high impact event. And I guess it's we're not blind to the fact that it could happen. We think it's unlikely, given that we've seen the reaction to the Russian invasion of Ukraine, and Russia wasn't that interlinked, apart from energy, into Europe, wasn't that interlinked with the world economy. China is much more interlinked with the world economy, so we think China would have much more to lose than Russia if it did invade Taiwan. Although where is logic in these situations? It's not logical that Russia would invade Ukraine either. So it's there in the background, and I guess it's a very small part of our thinking in relation to China. It's there, it's kind of lurking there as a outlier event that if it happened, it wouldn't be good news for any of us in all sorts of ways.
To add in perspective, I have a close friend who's a senior executive at Taiwan Semiconductor in Taiwan with the earthquake updates. Got some interesting videos. But anyways, I asked him, we read in the U.S., the concern. He said, John, it's not a concern over here local. I mean, whether they're delusional or not, but he said the local Taiwanese individuals, they're like, yeah, China's been a bully for a long time, and frankly, the logistics of launching an invasion is more chest pounding. And again, for someone that lives reading the local papers, talking to people, I asked him, are you concerned about evacuation? Your family said not in the least.
Yeah, that's
So it's
interesting.
just, it's one person's opinion, but that's a real live person I care about and talk to on a regular basis. And it was interesting, almost a relief to me that
Yeah.
the worry here in the Western papers, at least locally, is like,
Well, that's really interesting getting that insight from a guy who works there and is situated in the country.
Yeah.
And I suppose the other thing is in this day of satellite technology. I mean, you surely see you surely have some signs of amassing troops and things like that, and naval carriers and all this sort of thing.
And if there was a Chinese invasion of Taiwan and a response from the West, the Chinese holdings of the portfolio would not be the only things to suffer greatly. I think the entire equity markets generally, so that risk wouldn't be sort of constrained to your Chinese holdings. I think that's one of those high impact everywhere scenarios. But definitely on the radar and something that we have to keep considering.
just from a geopolitical standpoint, which I realize is something you're aware of, it's not going to drive portfolio decisions, but has there been historically in a geopolitical or potential geopolitical event, you said from a macro standpoint, the risks were so high we chose to tack away from the position. I'm just curious, that ever, an example that may have occurred?
I think it's, to be honest, it's always kind of inhibited our willingness to invest in Russian stocks, for example. It's not been a no. We have held Russian stocks in the past in this portfolio, but it's always been, hang on a minute, there's something here we don't quite like.
Okay.
But that's the only example I can think. I guess we've lived through a real amazing period, haven't we?
Yeah.
Where we haven't really had to think too hard about these things. So it's kind of changing a bit now. Yeah, I think even then it's kind of a marginal part of our thought process rather than central.
Did you get your answer? I sort of stepped on it. Okay. Anything else?
I want to thank you for the condensed, easy-to-read version.
Yeah.
Appreciate that.
I think it says before, of all the corruption deal, you present information in a manner, whoever is in your presentation, thinking department, you guys just do a fantastic job.
All right, well, thank you.
Digest, conceptually, again, it's just extremely well done.
We'll take that back to them. Thank you.
Please do, yes.
Yeah.
Thank you, John.
Thank you very much.
Thank you very much.
for your time.
Thank you.
I will walk on the table and do one more thing, and we didn't touch on it today, but we've talked about in the past that we spend more than half of our research budget away from the sell side and with academia to try to get different sources of insight. So rather than sending you electronic copies, it's a short paper that talks about some of our relationships with academia and different sources of information. Sorry, to do this at the end of the meeting, but possibly an interesting read.
Thank you. Safe travels.
Thank you very much.
Yes, thank you.
First thing, I stay away from academia. Okay. Brandon, you're up. I don't know which one you want to start with.
Well, after Matt's comment about, brevity and how nice that was in terms of. Now we got the 6 trees that we killed.
Thank you.
Thank you. Wasn't in reference to anything that I have on the table.
Right. So we've got 3 items for you. Hopefully they're in order. I attempted to put them in order. So first is obviously just the August flash update. I think you probably know this already, or maybe even have looked. Certainly August was not good. We had a nice rebound in July, and then kind of reversed. What's interesting though, 5 days, 6 days before the end of August, we wrapped it up. And then the market has really tanked right into the end of the month. So it wound up being down about 4%. A bit behind
These guys, on the short term, 1 month and a quarter,
Thermo Baby.
yes,
Yes.
they beat their intent. Over a 3-year, 5-year time span, they're just doing great. I mean, I'm just looking at the same stuff, except that I'm looking on
Sure.
the screen, but.
It's the last year.
It's the last year. But look at the numbers. They're down 41% over a year. Benchmark's down 25. I mean, that's a huge difference. I mean, both it's huge that they lost all that money, and it's huge the difference to the benchmark.
Right. And I think they kind of mentioned it, didn't go into the detail, but I think you can draw a direct correlation to essentially valuation and growth rates. So the higher your valuation or the higher the growth rates of your companies, the more they got hit.
Oh, sure, sure.
And not only are they international,
And
they're
we see it
international.
up above that's right, we see it up above in the domestic as well, so I understand that.
Same idea.
I'm not even criticizing it, I'm just
Yeah.
calling it to everybody's attention.
But it has been dramatic. Certainly, longer term, they've done incredibly well.
And will,
And
that's my theory.
well, and it also kind of goes back to the Brown discussion and some of the other
Mhm.
managers. If you've got a portfolio that's actually growing and earning to 15%, and valuation gets hurt, but they're still growing at 15%, that business, the fundamentals are going to be worth significantly more 2 years, 3 years, 5 years from now than they are today. And so the stock price eventually catches up. I don't know if that's next week or next year, but if truly the companies are performing that way and continue to do so, then it creates this huge value opportunity. And I think that, again, same sort of discussion with Bailey Gifford. If they're growing their earnings at still an incredibly fast rate, much higher than the broad market, then that value is there. It's just when does the market realize it? That's the fundamental question.
So the question really is, as managers, should we have pulled out of some of these people when the administrations changed from R's to D's? Because we should have known this was going to happen. And it did happen, just as we predicted it, but we didn't. And I'm just as bad at my personal stuff as I am here. But, and the answer to that is no, because you can't just keep moving the players around by taking away all their ability to perform, because you want them to perform down the pipe.
Correct. And you never know, I mean, it's easy to say in hindsight.
Oh, sure.
Oh, well, we saw inflation, therefore interest rates were going to move up, growth is going to be more challenged than value. But I think if you take it back even further, and look, so prior to the POV as an example, okay, growth had been running very well. And then you got a deposit. Now, it was an outsized deposit, but, absent the POV, you're still getting contributions from the city, or when you need to take money. We're looking at the allocation and making those tweaks. And in the case of the POV, we looked at the portfolio and said, well, growth has been on a tear, it's overpriced. So where did you allocate the majority of that equity money? It went into value.
Mm-hmm.
And it's not that you're making a timing decision to say, oh, well, growth is overpriced, so therefore we need to sell out of it. But you're just making allocation decisions to go heavier into value and sort of leave growth a little bit. And then conversely, this year,
When you have to take it out.
when you have to take money out, we would say, well, growth has been punished, so, and it's down, let's not take money from there, because ultimately the prospects there are the highest. So it's just, again, it's timing in a sense that you have cash flow needs, and you look at the portfolio, but from a top down, we would never suggest you say, oh, we think it's going to be a bad year for growth, sell out of growth and put it in value, or vice versa. More just kind of that ongoing rebalance and tweaking.
This may be a question for John. I mean, we're looking at a 1 year number that's pretty bad, obviously, which is fine. Or understandable, I should say. What is our process for review and monitoring of managers, and or at some point if there needs to be a recommendation for a different manager? And just in general. I'm not one to fire anybody quickly by any means. I'm just curious what the process is.
Basically, this board makes recommendations. Then the trustees have to make that. Obviously, we work very closely with the staff. The staff is putting a lot more time per week than we are. But the answer is that that's what we have. ANCO here helping us understand. I think fundamentally, performance is going to wane and exceed, over time. It's just part of it. And we have different flavors of the portfolio, if you will, and there's a time when certain flavors are in favor and certain flavors not. I think the key is when we hire these managers, we say we're hiring them to fit a certain piece of the puzzle. And we're always going to do it perfectly, right? We don't know what the future holds. We're saying, do they have a rational process? And our bias has been for years is we like active management. We like management teams that are actually going through and saying, is the management team lying to us? Are they cooking the books? Is their business actually growing? And fundamentally looking at the debt levels, all that stuff, which I intellectually have a bias toward. So then we look at, are these, I would say when we fire somebody, are they drifting from what we hired them to do? Are they changing their stripes? And I think that's come up a number of times with Brown, and as an example, and what the answer's always been, no, Brown's doing exactly what we hired them to do. And so the question is that how much is on us trying to shift around these different pieces? And ultimately, that's an allocation decision that we build up the long run. And so where I think our value is finding, I think most importantly, if there's a problem developing at a management team, then we need to address that very quickly and make a change. And that's happened a couple of times. The last tactical decision we made, which despite this year I think was sound, is we got rid of what was it? Our bond manager we had for many years. Richmond Capital. And Richmond, very fine firm, top tier producer, but we just said, look, your part of the world is going to stink. and so we made the decision to take on more volatility in our portfolio. And I would argue we sidestepped the permanent loss of capital in the bond market. Now that starts getting more interesting, we want to start.
So we have to back into the other side.
Yeah. But again, to your question, it's really, we have a pretty broad allocation decision. It's what we do is we're trying the actual players on the team. Who's supposed to be a rebounder in basketball, and who's supposed to be a shooter? Well, if you're a rebounder, well then if you're pulling up the 3-point shots, you're like over 80 this season. Guess what? That you have funded the person in that position. And so, let me ask you: do you see broadly with our mix of managers? Obviously, we're tilted to our equities long run. We're perpetual fund. Where when times are good, we look like geniuses, and when the markets are down, we're bottom 5 or 10%, and that's been going on for 25 years. Is there any players that are pulling up for 3-point shots that haven't hit one in like 2 years?
No,
Okay.
we are not seeing that, and the other thing you kind of touched on it, one of the things that we will look for is obviously kind of behind the scenes changes to the team structure, philosophy, that you don't necessarily see in the portfolio performance, at least right away. So you can have bad performance. So Bailey Gifford was just here. They're 15%, 16% behind for the last 12 months. Are they all of a sudden trying to go buy value stocks because they realize growth's getting hammered? To me, that's more of a concern.
That's a sign.
Than it is, because again, you take any investment process, as long as it has some sort of reasonable, criteria and just thought process to it. If you do that consistently over 10 or 15 years, you're going to be overall in a reasonable place. The thing is, you can't jump from one thing to another because you can't drive looking out the rearview mirror. Correct. It doesn't work. And so, yes, underperformance. We talked about like Brown, and I even have the additional book because we kind of brought that up last time. To your point, are they all of a sudden buying value? Are they buying smaller cap names because for whatever reason what they're doing is not working, and you'll see in a minute that's not happening. So it's really more just the kind of the nature of the portfolios, concentrated portfolios, and to me the biggest thing is the index, which we touched on.
And I'd point out, there are some plans who might have language in their investment policy statement that says if a manager underperforms for 2 or 3 consecutive quarters, they go on a watch list or something like that. And we've never done that. It's more of an informal.
Yeah, we do. We just don't say it.
Yeah,
It's not in your policy. It's not a forced criteria. Correct.
Did we bring Twin on also? We've got Twin on also within the last 3 or 4 years, something like that.
Yeah.
Correct. Yeah, it essentially took some of the Brown money and put it into Twin.
That was done just before I came on because there's been no movements, Matt. There's been no movements as long as I've been sitting.
Yeah. And the Twin was actually the former CFO of GRU believes strongly in indexes. I think he was looking at the rearview mirror personally, and I respected him. We just had a completely different philosophical approach, but that was in some ways we made that right as an accommodation to him, and there's time.
And it may still work out.
Yeah.
And the other thing that's sometimes gets lost, but if you look at the 10-year column, even though Brown has underperformed, it's the second best performing portfolio over 10 years. So it's not as bad as it could be, so to speak. So absolute performance is still there. Obviously, yes.
The 2 international ones are not Just interestingly, I mean, just,
Yeah.
if you're looking at the 10-year problem.
Right. Relative performance has been very good, but absolute, they've been underperforming domestic. And that's, it didn't come up today, but that's been an interesting discussion. 2 years ago, 3 years ago, it had been 7, 8, 9 years that domestic stocks had done better. So one of the discussions is, at some point here, international is going to have their day in the sun. And here we are yesterday or the day before with the dollar still hitting another all-time high. So that is a headwind for international, not to mention all the geopolitical issues and things like that. But at some point, that is going to, flip back the other way. Because, historically, international performs at about the same annualized rate as the domestic stocks.
Over the longest
Over
haul.
the longest haul. Now, there's discussion, well, because of globalization, all these things, maybe it's moderating, but again, at the end of the day, I don't think the dollar continues to strengthen forever. Interest rates in a lot of the rest of the world, especially EM, are pretty elevated. They kind of move very quickly. And as inflation does eventually subside, they start to lower those rates. And I think there's a kind of an impending tailwind in a lot of those markets. The question is, how do we get there?
I meant to ask them about Brazil, but I forgot to ask, so too bad.
It's just
That's a
amazing
disaster.
that in 28 years, it's like
I had a friend, I said,
4%
Brazil's the country
return,
that.
28
he said,
years.
Yeah, and
How many
always
funds
will
would
be.
say that?
Are you talking about the total fund?
Yeah, total
It's,
fund,
yeah, it's cultural.
Yeah, it's a lot of things.
And again, that's a net fee.
I never
number
worked
also.
my way through a worse
Not a
airport
gross.
than I did.
If you,
in
gets back to the discussion, if you had all index
Oh,
funds,
okay.
you could have had 7.6, the same allocation, but, with just index funds. But ultimately, using that active management, you've got, a significant advantage. And again, it's 75 basis points, which doesn't sound like a huge number, but you
20
compound that over 30 years, and that's millions and millions of dollars.
Seems like it used to be a bit higher, and we've come down in the last couple of years quite a bit. I mean, I
Well,
remember it was 10.5 for a long time.
Yes, anytime, well,
Bad markets
Yeah.
draw,
the last 12 months are down 16%.
yeah,
And you know how endpoint sensitive these are.
correct.
If for the next 12 months, we were up 16%,
That number go back to
that
10.
probably goes right back to 10,
Yeah.
which is crazy because it's not like 1/30th of 16%
Yeah.
is 200 basis points, but just because of the way the compounding impact works,
The
it
asset
has,
amounts compared.
yeah.
We have a question, obviously, we're in a volatile market and we have some funding, so, I mean, where are we going to access liquidity to kind of pay?
I was talking to Brendan about this. We're going to take the majority of it from fixed income. The idea is just to take it from the managers who have the least potential to recover over the next 6 to 12 months. So we're going to take it from the value managers and from fixed income.
That makes sense.
And it's going to be about 30 million.
When do you do that?
I'll probably send the letters of direction to State Street today. We need to have the money internal to the city to bring our pooled cash numbers positive by September 30.
And could you, for the board, for everyone, I think we know it, but just explain how we go negative against how that works.
Sure, so, in the past, the finance directors who sort of, I worked with the finance directors and the city manager, and we had finance directors previously who liked the idea of sort of creating an internal arbitrage by, so we have a pooled cash number for our pension plans. And it's really the cash that's held internal to the city, not in the State Street investment account. That cash balance goes up and down based on employer and employee contributions, which go into it every payroll, and then employee benefit payments to retirees that go out once a month. And that's a negative cash flow on a monthly basis. It's about a negative 1.5 million or 2 million a month. Or actually, it's more than that. These days, we've kind of changed the way we do the contributions, but after the pension bond issue, the city makes less contributions to the plan than it had before because we funded it with all the pension, the bond proceeds. So that cash flow has gotten more negative. If we don't pull money out of the investment accounts, over the course of a year, we'll end up with maybe a negative $30 million, maybe 25. We've got some issues with our accounting division and our ERP system, so I'm having to kind of estimate what that balance is. I can't get a true general ledger number to tell me exactly what it is, but I imagine it's going to be negative 25 to 30 million.
And that represents the payments going out to existing pensioners versus the money that's coming in from new contributions.
Right. So, ballpark, we are paying benefits of about $45 or $50 million a year to retirees, and we're bringing in contributions of about $15 or $20 million from the employees, active employees, and employer contributions. So that differential is where we get the negative 25 or 30 million. And because we think that the pension plan investments are going to earn, between 8 and 10% a year, it makes more sense to allow the cash to stay invested that way rather than bring it internally and have me invested along with our other operating fund cash, which, I'm buying agency bonds and corporate bonds, and we use the State Board of Administration Prime Fund. But that's generating, those are much shorter term investments. We're generating much lower returns there of, how the SBA was paying 10 basis points last year. It's up to 2.5% now with rate increases. And the bonds I'm buying, I'm buying agency bonds that are in the 3 to 4 to 4.5% range. But still, that's not 10%. So over time, you're better off having the money in the pension plan investment accounts. That may actually change. We've got a new finance director, and our auditors have mentioned that they would maybe recommend that we do quarterly withdrawals from the investment accounts to not let that balance go negative at all. And if that's the case, then what I'll end up doing is, rather than doing a $30 million withdrawal once a year, I'll do 4, 7, or $8 million withdrawals during the year. And I'm indifferent. It doesn't matter to me. We would lose a little bit on arbitrage over time, I think, but if that's what the auditors recommend, that's what we'll end up doing.
There's some big, back to the envelope, so if I use $30 million as the net withdrawal from the fund, I divide that into 604 million, that's basically, it's a 4.9, I call it a 5% negative draw rate coming off the portfolio, which is historically been pretty good. My personal planning, I use a lower return, but I'm not particularly more cautious than the average bear, so that's like an 8 or 9%. Now this is not going to work out. Obviously, the city, when they do the valuation, I think we do 5-year smoothing, so they ultimately have to step up. The city or the local taxpayers should have to step up if we don't hit our assumption rates. And ultimately, new money's got to be put in by the city. That's the pension obligation bond was a strategy.
We over 100%, that's fine.
Yeah, we're like 115, 116% funded, I think. And it depends on whether you look at market value versus actuarial value, because the actuarial value includes the smoothing. We also lowered our rate of return assumption to 7.75 from 7.9, and that was sort of, we did that through discussions with the actuary and the city manager and the Division of Retirement. They give a lot of pushback. I think the State Division of Retirement would like to see all local law plans use like a 5 or 5.5% assumed rate of return. To me, that's ridiculous, but over time, we've lowered. When I started with the city, I think we had a 10.5% rate of return assumption in the 90s, and we've lowered it gradually over time. I'm not sure how much lower we want to go. We might get to 7.5% or so, but I don't see the point of going much lower than that. It just forces the city to over-contribute on the near term if you use that sort of rate.
I have a question, a little bit on topic, but off topic. I've gone to the city budget. I've tried to figure out where in the budget shows the interest and the payments to the pension obligation bonds, both what we did a number of years ago plus the more recent one. So I'm just kind of curious, because it's not a free lunch, right? I mean, the city is paying interest rate. Do you know where that is? I've looked around and
I'm not sure exactly how it's denoted in the ACFR. I'm not allowed to call it CAFR anymore. The ACFR, which is the comprehensive financials for the city. But I can provide you a debt service schedule for those, and you can see the dollar amounts.
I would be curious.
And, basically, I think all in, it was around 3% that the city's paying on the pension obligation bonds.
Right.
And, ideally, we're gonna earn the 8.5% or 9% over the life of those bonds. So it made sense. But I can find that and send it to you. I don't really, our accounting area kind of keeps track of that, but I can get it from them.
I just be curious. And again, it partly based on later on, our discussions with the couple of city commissioners who were on the trustees a couple of weeks ago. I mean,
And we're still paying off the 2003 pension obligation bonds as well.
well, I would like to, if need be, remind the sitting trustees who actually make decisions that the overfunding of 110, 115% actuarially, that's looking at the pool of money here. There is some financing there's still an outside cost that you have to be cognizant of before anyone starts giving away the store. And it's one of our commissioners.
Just compare
So,
2003 when they did the last
It's kind of scary.
I'm sorry?
one. In 2003, you were 100% funded. And by the time they did this one, it was 71% or something.
So the funding level we shot for in 2020 was 95%. But as soon as we put the money in the markets, we earned 25% on it. So that shot us up to like over 100% funded. In 2003, it was a much lower percent funded ratio that we got to. I think it was maybe 80.
Yeah, the 80, 82.
Something like that. And then some of that was negated by the fact that we immediately, we should have lowered the assumed rate of return before we did that pension obligation bond issue, but we did not. They waited until after we did it to lower significantly the assumed rate of return. That created a big liability. So we went from being like 80 or 85% funded to like 70% funded when we did that change. That was just a timing error that, it didn't change the amount of money we had. What would have happened is if we had lowered the assumed rate of return before the bond issue, we would have issued more debt to get to where we needed to be. So the city manager at the time wasn't comfortable. He thought that was manipulating the bond issue. So.
Other thing I just came across these numbers. I'm trying to internally verify them, but I just thought it would be an interesting little anecdote considering we're looking at the negative numbers here in the report that we are. It looked at every midterm election year going back to 1954, I think. And the average drawdown at the low point of the year, now obviously that can vary. Sometimes that low point was in March, sometimes it was in October, but the average was down 15.5%. And in every single one of those periods, from that low, 12 months later, there was a gain. And the average gain was 16%. So just to kind of overly simplify experience that within a midterm election year, it is not uncommon to see some fairly decent sized pullback. Argue there's certainly fundamental reasons, extended valuations, inflation, all of it, that it's happening this year. But if you just sort of overlay that mid-year cycle, it is almost a fairly common occurrence to have a market like this. And of course, then hopefully the silver lining is 12 months later, things start to look a lot better. We'll see if that plays out. But I'm trying to get those numbers kind of confirmed on our end, and I'll certainly share that with you if I can do that.
I'm certainly not going to give you confirmation, but I do have a piece from First Trust, which I know John does well, and the numbers are exactly the same. So,
Okay.
yeah, I mean, and basically, since 1950, the 12 months post-election, midterm election, it's never been negative, ever, since 1950. Now, that's only 18 or so samples, but still, I mean, it's pretty powerful numbers. But
Well, and I think everyone in the room recognizes that one of the things that the market struggles with most is uncertainty.
Sure.
And anytime there's an election and you don't know the result, you don't know what the rules are going to be for the next 2 years. And once you get to that point, good or bad, you at least know what the rules are going to be.
Correct.
And that helps the market relax.
Yeah, two factors, the other being confidence.
Yes, certainly. So if there aren't any other questions, I'll kind of leave it there with the flash report. Touch briefly on the growth portfolio analysis that, again, you've seen this kind of a few different times. It's obviously updated through June 30th. I'll touch on page 1 briefly just to kind of highlight a few things. First of all, each of the managers. So you've got Brown more or less on the far right, just to the left of the index fund. Then Winslow, Alger, MFS, and then Poland. That's not one that I actually showed you before, but I thought it was probably more similar to Brown in terms of concentration, and so I thought I'd include them as well. So top line, you can see holdings. I mean, Poland is at 24, Brown's at 33, certainly the most concentrated of the group, and then the other ones obviously range up from 50 up to about 81. Other thing I like to point out is the percent of the top 10. So the index, 46.2% in the top 10. Now, because these are relatively concentrated managers, a number of, or all essentially except for Winslow, have a higher, Brown and Alger are slightly under, but MFS and certainly Pullman are more concentrated within their top 10, but obviously those stocks differ from the top 10 of the index itself. And again, as a reminder, the index essentially just takes the weighting of the largest companies. So the companies that have been doing but better become a larger weighting as you go and sort of snowballs. So I just kind of wanted to provide a little bit of that context for you.
obviously, the market cap of Brown is significantly smaller than the rest, which, I mean, it can be a good thing, obviously. I'm not saying that as a negative.
Yep. It certainly is, and obviously it doesn't take many stocks when you're only at 33 that it kind of brings that down quite a bit. But yeah, they certainly have been a bit smaller, which has been a little bit of a headwind, because generally the larger you have been, and a lot of that is a function of not owning the same type of weights of those biggest stocks. If you're not owning the Microsoft and Apples at 10% of the portfolio, you're naturally going to be a smaller market cap because those are the biggest ones.
But Alger shows the highest number of holdings, but the lowest only ROE.
Correct. Yeah, and again, we come back to the fundamentals. You know, if I look at the earnings growth, you know, the index is at 12. You know, Brown's at 15. You do have 18 from Alger. But if that growth actually turns out to be true, that's always the secondary thing. You can have a growth expectation and then not meet it. But if ultimately the companies perform at that sort of rate, then that's the building value that has yet to be realized. The other question that came up really about style. You know, is somebody, other than being a little bit smaller, are they buying value stocks and what have you? If you look at page number 3, you really get the scattergram to show in the upper right-hand corner. You see all of these managers are very true in that large cap growth space. Obviously, some slightly smaller than others, but definitely very consistent. And then the other thing to point out on page number 4, talking about performance, look at the 3-year column. So these are different style managers, varying levels of concentration. The index has done 16% for the last 3 years. The best performer has done 12. All of them are significantly behind on the 3-year, 2-year, 5-year. They're actually all still behind, 16.3. The best performers, 15.2, which is actually Brown over that 5-year period. And so this discussion we're having about Brown is certainly not unique. I've been having this conversation essentially with every plan that has a growth allocation, because it's been incredibly difficult, in particular these last 2 years. I've shown this type of analysis to a few people, and they said, wait a minute, for 10 years these managers have been underperforming? It's like, well, No, they actually, generally, on average, we're doing better for the first 8 years. It's just been such a difficult environment the last 24 months that it's pulled all of those longer term numbers down. And what I would expect to happen is to get a little bit of a bounce back the other way. You know, I don't know if it starts next week or next year, but generally speaking,
Post-election.
it very possibly could be
No,
post-election.
that's a good answer, yeah.
And I think, correct me if I'm wrong, but some of these other managers you're comparing Brown to, they own some of the FANG stocks, right?
Certainly, yeah. I mean, they don't
Brown
necessarily.
doesn't.
Yeah, they don't. I mean, Poland, their largest position is Amazon, but they're underweight, say, Microsoft, and so the other. So
You
obviously,
have a top 10 in here, all their.
it doesn't list what the top 10
Okay.
are, just the kind of the weightings of them characteristics.
Okay.
Speaking of the index, and I'll share this with you, probably are all right anyways, but it's, you know, this, I call it the cult of indexing, right? Where you do passive investing, and the idea being, you know, 1972 and, you know, 78, I guess when Vanguard started really, you know, adopt that, and some of the academics said, hey, you know, indexing's cheap, right? You can buy a Vanguard 500 index annual fund for two basis points. I mean, I'd say it's free. And the idea being that you can kind of free ride on all the people that are actually doing due diligence, and you know, why pay for a bunch of research people when you can just buy an index because all these active managers are betting companies. Well, that's fine when passive investment is like 10% of the market. Now I think it's like 75 or 78% of new flows are going into these passive investments. Probably because regulations say anything that's cheaper is better, irrespective of the quality. But now you have far fewer people actively looking at trying to divine whether a company is worth something correctly priced in the market, because everybody is free riding, hoping everybody else is doing business. Well, you got the vast majority of money just trying to piggyback on ever shrinking number of people making active decisions. I would argue those indices get dumber and dumber and less efficient. And so eventually my expectation is, and I don't know, one guy is, there'll be a revision of that. These indices people are going to abandon them. And when they do, they're going to abandon them en masse. And a lot of these really big cap companies, I would suspect, just because of supply and demand, are going to get their butts kicked. And they may be perfectly good companies, but when you have a whole bunch of passive investors realizing that this isn't working as well as it was entitled to be, because the fundamentals have changed about how it's constructed, I think these really big mega cap companies are going to be in a world while that resets. And that's my concern.
The inverse of that is you're saying they're artificially inflated.
Yeah.
And all that's going to happen is they'll go where they ought to be.
Exactly. Yeah. It's my expectation. I think
Some of the proponents for indexes say, you know, to John's point, if 70% of new money is going into the index, that's just going to continue to drive that performance forever, then you shouldn't go active. You know, that's kind of one argument there. One of the other things that I would say too is if you think about an index, I mean, all it is it's an investment strategy. It just happens to be low cost. But the strategy is momentum and size. You're putting your largest holdings and weightings into the companies that are performing the best.
have performed the best.
Have performed. So it becomes this momentum
We're back
strategy.
to the rearview mirror.
Right, but then that flips and it becomes a negative momentum type of situation.
When it flips, I mean, the analogy, I'll shut up, but no, I say, look, let's just take two scenarios. You have two investors, each are going to be given $100 million to invest in real estate and electrochemical. The first investor, what you're going to do is you're not going to waste money on a
paying
realtor
taxes.
and all the annoying costs. You're just going to go ahead and start buying the most expensive piece of property first, whatever's listed on it. You're not going to figure out what's valued. You're just going to buy the biggest, most expensive piece of property until you basically whittle down your $100 million. All right, so then, but the good news is, hey, you're paying realtor costs. You haven't wasted any time with those darn, appraisers to see what's actually valued. Whatever was offering the price that was. So some investor has the same $100 million and is stupid enough to actually hire a qualified realtor that kind of knows which neighborhoods are in the growth path of expansion, which are falling apart. To be able to go through and look at different properties, say this particular owner has a delusional idea what their property is worth, so we're going to avoid buying that, but you're going to have to pay some more costs to acquire those properties. And so I would argue in 10 years, in the scenario, who do you think's got a better chance of having a better return? And everybody says, well, obviously the person that's picking up the going property by property and deciding what it is versus the guy who's just buying the most expense of one all the way down to the money's used up. And I said, well, that's what an index, option one is an index fund. Option two is the active management. And so, to my point, when you get 75% of new money going passive, eventually that thing's gonna unwind. I like the idea, I always have, of the back to managers, and to Browns, and I have no skin in the game for Brown, but I like the fact that they're not buying these huge mega caps blind, like a lot of index managers are, and I say closet index managers they claim they're active, but they're 95% tracking. Anyways, enough of my preaching for the day.
Well, what I think will be really telling is that obviously this has been an incredibly difficult period. I suspect this turns around at some point here next 18, 24 months. The question is, how do we recover? If we don't see that sort of relative recovery, that's probably a little bit more concerning. But again, obviously they're down, but I see them down with everyone else.
I mean, if I'm not mistaken, their July performance was pretty good.
It was, yeah, they had
It was in line
through
with-
July and back down in August.
And everybody
but-
did, but I just mean as far as relative
Relative, yes.
performance, I mean, it's not as if they're not performing in good markets. July was a pretty good month overall for
Right.
most.
They got blindsided by the Chinese regulations, and they didn't expect that, I think, and that's a lot of what happened there, and so now they're just adjusting to it, it'll take time, but I think we still have faith in their investment thesis and how they work.
Again, the other thing that I would say too is, 90% of the return, you guys probably know this very well, 90% of the return you get is by being invested in the asset class. It's only the 10% differential is the actual manager. So the most important part is having that growth allocation. And we're talking about a relatively small differential in terms of the relative performance versus the index. But like we mentioned earlier, even though Brown has been under, they're still the second best performer in the portfolio for the last 10 years because you've had the growth exposure. And that's ultimately the key.
Depends on what 10 years you think.
Well, of course.
William, what has been the wisdom of the city commissioners as far as looking at the respective managers in the portfolio and how they perform versus their benchmark? And
So they don't really get into that detail,
Okay.
and to be honest, I just try to do what we do quietly and not raise a lot of attention to the plans. But, as you guys have heard from me earlier throughout this year, we've got a couple commissioners who, have started paying more attention to the pension plans and are interested in ESG type policies. And we're trying to deal with that as best we can. And John came to the last Finance Committee meeting and gave a great presentation or had a good discussion. And of course, they went ahead and did whatever they wanted to do, and they've asked us to come back and provide some more information. So we're just trying to work through that process. They generally don't know enough about investing to look at a manager and even understand what asset class is which, and they don't have a real understanding of what the benchmarks are and how they compare and relative performance and things like that. They see a total number for the year, like we reported in the previous year that we had earned 23 or 24% over the total plan, and they were very happy about that. They know we're down this year. We try to encourage them not to get too involved in pensions, but it doesn't always work.
The one takeaway for the presentation, and I thought we did a really good job, and there were basically 3 commissioners, like a subcommittee that report to the overall trustees, and the one commissioner, I won't get political, I won't mention his name, but he, after the city attorney had clearly stated that as trustees, they have fiduciary standards they have to be mindful of. Specifically, they have to make sure that they're seeking the highest rate of return for the minimal level of risk. And the one commissioner said, well, he's going to save the planet by doing ESG screening, and basically said this is the time to break those. Basically saying, I'm not going to hear the federal regulations or the fiduciary standard. And I was frankly shocked that he said that in a public forum, but he could have given a rat's ass about his responsibility as fiduciary and how he can still be sitting on the commission board or as trustee. For the public foundation, I would have had him sued or filed, removed immediately from the board. He's a city commissioner, to the point we try to keep them, we want to give the information they need to make good decisions. But sadly, we get people that are really willing to violate federal law and will dismiss the recommendations of their own attorney. I don't know what you do. But it was, to say it was troubling to see.
Let him do
Yeah.
it, and then.
The
members could.
I was gonna say, let
They
me
have
have
fiduciary
that.
responsibility,
Yeah.
which means they have a liability, which means somebody could go after them. I don't know who that'd be.
I agree
union-
with Commissioner.
the union and
I think there's.
Members.
One, as you would expect, this particular individual, I don't think has much to be recovered in the lawsuit because of the skin in the game. But I think that there's limited liabilities, trustees. I've asked the attorney in the past, we had some issues, and I said, what is the personal liability for the commissioners? And I was told years ago that once they're out of office now, so they can, which is to me.
Well, you see that playing out with the reclassifying of all the properties, single-family restrictions.
I mean, it's illegal. You can't. But again, so we're, I think this board, we can advise. That's all we can do. And let's just say I had to hold my tongue greatly at that last meeting.
I'm proud of
Out of your mouth? Was it in your mouth or out of your mouth?
you. He didn't come out of the chair.
But it's, I could ultimately see if trustees of this plan really go off the board, we may have to recommend some type of legal action to stop. And I say that, I don't say that lightly, but this is one individual. I think there's a consensus there, but it was troubling, to say the least, to see their response.
And just to follow up, what they requested at that meeting was for us to come back and give them a presentation on how other cities are implementing ESG. And, I haven't actually started working on it yet because we're at our fiscal year end, and like September and October are our two busiest months because we're trying to prepare for fiscal year end, and then we're trying to report on fiscal year end. And their next meeting was scheduled for the end of November, but then it got moved forward to the beginning of November, which means I would have to have that report ready to submit by the first week in October, and there's no way I can do that. So they only meet quarterly, so if we don't take this report back to them in November, I think it's going to be, January or February before they meet again.
And new faces makes the whole issue move?
Well, maybe not move, but there will be new faces on that committee.
We could hope.
Well, I know, one at least. One, the commissioner that John is referencing is, he's done, he's out, he's term limited and won't be on the committee anymore. The chairman of the committee is running for mayor, and so if he wins as mayor, I don't know if he would still sit on that committee or not. So we could have two new members on the committee.
Despite a great deal of political positioning to the various spaces, two of the members of that board did not decide. One member wanted to go ahead and start doing ESG immediately and pass the recommendation. The other two said, let's slow it down. And I would like to think between Williams and mine's comments that may give him some pause. And certainly, when your attorney says you can't do something and you're willing to ignore that, I was like, wow. So, we'll see. I tend to think the gentleman that might be maybe for least judgment is not going to be in public service, at least in his current position. And so we'll see. But it was something we need to be mindful of. And it's interesting meeting.
And we'll keep the
I'm
committee
glad you
updated.
went.
I kind of am too.
Well, no, I mean, you represent us well.
And it was very clear they had not read any of all the work the staff had done. I mean, I was like,
We provided detailed analysis from almost every manager on how they evaluate ESG factors and incorporate them into their processes. And to me, to me, any reasonable person will look at that and be satisfied that that's enough. And they have not.
ultimately, they do have a fiduciary liability that can be held to think personal liability, the driveway impact. But what we said,
The other item I have for you is kind of follow up. We briefly talked about some real estate last time. And so what I have for you today, and again, I do not view this as something that's on fire, has to be addressed right away. But really just beginning a conversation. This first book is looking at open end, so similar in structure to what you have currently with the principal, but it's core plus. I mean, you're essentially saying it's 75% like what you have already, and then call it 25% of the portfolio has got a little bit more juice. So they can have a little more debt or mortgages on the properties, and then they're also looking at a little bit more development type areas of the market. So I don't know, how much you'd like me to go through this. There are 4 firms kind of being presented. I'll start on page number 2, kind of list them. We've got American Realty, JP Morgan, PGIM, and then Principal, your current manager. They also have a core plus type strategy. The one thing, and again, Pat's in real estate, so I'd love to hear his opinion on this. Partly the way I look at it, and the reason I kind of introduced the question is I suspect that sometime over the next 18, 24, 36 months, not that necessarily real estate collapses, but there's going to be more pockets of dislocation because of higher rates, things like that. And so just maybe considering having a strategy that can take advantage of some of those things. And in a core property fund, you're always buying existing, fully occupied, listed properties that are valued. They're going to tend to ride the valuation wave, as opposed to a core plus, where you can do some development, you do some value add, you buy a depressed property that maybe is vacant or only 50% leased. You put some work into it, you piece it up, and you kind of create value. So that's kind of the idea in thinking that, again, over the next number of years, there's going to be more of that opportunity. And so that's kind of the first stage, looking at, again, open-ended structures, so like you have, but have a component that can get into that value add and slightly opportunistic areas.
And your recommendation is?
Certainly to consider. The other thing, we really have not done any closed-end type vehicles. The other, and I don't have a book for you on that in part because a couple of the names that we have in closed-end are wrapping up. So if I showed you two in the book, you wouldn't really be able to get in them in time before they closed. So maybe it makes sense next time I can have a new book. We're always underwriting new strategies in that area because they're only fundraising for 6 months or 9 months at a time. But to bring you some other funds. The advantage of those type of vehicles is you don't come in with any property. So one of the disadvantages to something like this, if we move into a core plus, you're buying into an existing portfolio of 80, 100, 200 holdings, and so any current valuation changes obviously impacts you. The real values in that kind of 20,
Expecting some
25%.
negativity in that area. Are you suggesting that we do away with principal, take part of principal stuff away and give to this? How?
Yeah, I think it would more be kind of like a partial cannibalization. I think you maintain core, and I'll use the analogy of large cap, mid cap, and small cap. Okay, it's not a perfect analogy, but your core real estate, that's your large cap equity. Your core plus is kind of your mid cap equity. And then small cap or micro cap kind of becomes the closed end type strategy, not only in risk, but also return. And so you've got your core large cap, sort of already covered. Now the question is, do you take maybe a piece of that and kind of do a smaller kind of mid cap allocation, if you will, or potentially even go down to as far as the smaller cap of the closed end.
Are you thinking of taking anything out of the principal account for what you're fixing to do, or are you going to take it all out of the fixed?
It'll be primarily fixed and then value equity, so.
Gotcha.
Yeah.
So you've got 33 plus to play with in the principal. You're suggesting take 10 or so?
10, 15, yeah, something like that. And I mean, there's also a side benefit. Obviously, it'll take a while to get that money out because all of these funds, or most of these funds, have instituted a queue. so it takes a little while now.
All right.
You know, most of them have been running about 25%. So if you request 10 million, you know, you're getting roughly 2.5 million a quarter. So it's taking a number of I mean, well, there's been so many,
So we
because.
gotta get the request in right away.
We're not talking about implementing this for
Yeah,
another
this doesn't have to, and again,
year and a half, 2 years.
All right.
and maybe the queues will have subsided by then. It's difficult to know.
I don't know anything about that, I'm just asking.
And it's changing so much.
Yeah, well, and the reality is, the queue to get into a fund, you don't fund it all at once typically. It's typically called in over 2, 3, 4 quarters. So there's a good chance that those processes would kind of, you know, merge or
Yeah. Okay, all
marry.
right.
Because apartments were cold, now the interest rate's up, apartments are gonna be hot. And warehousing was big, and now who knows what's gonna happen with the economy, so warehousing, like Amazon's cutting back.
Correct.
They don't have enough
So
buildings to cover the city.
strictly from an opportunistic perspective, I think the closed-end type vehicles, which are really skewed toward more of the opportunistic. So value add or kind of core plus is again core with a component, but again, you're coming in with an existing portfolio. In the closed-end funds, you're starting with nothing. So the fund is going to raise 500 million, a billion, whatever that number is. They have 0 properties on the books for that fund, and then they start putting that money to work. So from an opportunistic standpoint, I feel like that's probably, I mean, certainly you're going to get the expectation of the best return out of that. But from a vehicle standpoint, your money's locked for 10 years plus. So you're committing, and it's administratively, it's more of a hassle. There's more capital calls and things like that. So that is something we could consider, but this board, this fund has not done anything like that. One thing I think it's important to note, with your allocation, we're obviously heavy equity. I don't think what we're seeing or talking about is, even if you decided to do nothing, this doesn't diminish your chances of meeting your super rate return. I think you still get there. So it's not like you need to allocate here in order to make your bogey or anything like that. It's not like there's a problem. I'm just kind of throwing out that, you know, you used to be a little bit higher in real estate. We brought that down a number of years ago. And I see on the horizon some opportunity. And so maybe something for consideration. That's kind of the idea behind it.
In the real estate years ago was, we sold a lot of our bonds off and we put in real estate. Recognize we're taking on some additional risk, but in hindsight, that was the correct decision. And so my question would be, if interest rates keep going up, at what do we say, the real estate was basically a decade replacement for bonds, because we thought bonds were going to do well. We were correct on that. And so the question is, what time, maybe the old traditional bonds, I mean, if my cap rate on this expected return is 7.5%, you get 6% on bonds, then you start asking yourself, with liquidity and everything else, do we go back to more traditional bonds? That's an allocation decision. I do agree there's going to be massive reworking, redesign of real estate, especially in the second, third tier markets. And so now there's lots of money being raised in Wall Street, venture, basically vulture funds are raising capital, waiting for the collapse so they can come in there and recalibrate. I think that's almost inevitable. Malls going to be reworked, a lot of these office spaces in some of these areas. San Francisco's got 38% occupancy in downtown San Francisco now, and there's someone's going to take it in the shorts badly, but somebody can come in and pick up assets, and that song, I think, has got a very nice window. So I kind of concur there's an opportunity sometime the next, I don't know when, but sometime I think opportunity present itself. But the question is, allocation, do we consider, or when do we consider moving back into more traditional bonds when we think we get paid for it relative to the real estate? I don't know.
Yeah, I mean, your core, kind of core plus real estate, you're yielding 4.5%. So when your 10-year was 1.5, that was a really nice income trade. Plus, you get the upside potential of the real estate, beyond the income. Now you can get 4.5% in an average bond portfolio, and that's probably ticked up just from yesterday, and it's likely to tick up some more. So if we're sitting here 12 months from now and you can get 6% in a bond portfolio, all of a sudden that differential is a lot less attractive, certainly on the income side. And that's why what I would tend to say is that I would skew toward reducing core, because again, that's more of an income play.
Yeah.
as opposed to the closed-end vehicles, which is more of an opportunistic value creation play. Because I think, again, with rates going up, the income play of core is subsiding. Now, you still get some of that inflation benefit. Obviously, if there's, by having a real asset, if there's continued inflation, you get some sort of rise with that on top of the income. But I think that the bigger component becomes that value creation.
As they approach each other and returns, is there a mechanism for laddering bonds?
Is there?
Well, I'm not sure what Loomis is.
Right. I mean, there are managers that is essentially their strategy is to ladder. But I don't know. I'm trying to think how you would ladder between like a different asset class and fixed income. I don't.
Well, no, I'm just saying like laddering bonds, just
Yeah, that's.
do 12 to 18 months with rollovers. And if rates are going up they're probably going up like crazy. Is that a safe bet? I'm just sort of out there.
If you look at the expected forward curves on rates, you see, and it changes daily, of course, but you tend to see an inverted curve going out 3 to 6 months, and then a more normalized curve after that. So there's an anticipation, I think, that the Fed's going to raise rates to the point where they get inflation under control, and then they're going to allow rates to come back down a bit. Whether that pushes us into a recession and what impact that has, who really can tell. But I'm buying bonds right now. I'm buying agency bonds for our operating portfolio in the 1 to 3 year range. And I'm staggering those maturities, and I'm buying a few 4 or 5 years as well. But, if you look at yield curves on agencies and treasuries, the 1 to 2 year range is where the highest rates are. Mm-hmm. And the question is, well, how long does that last? And if I've got 2 year bonds now, when they mature, what's the yield curve going to look like, and how am I going to reinvest? So, I'm doing that, but I don't expect 2 years from now to get the same rates out of a 2 year bond that I'm getting right now. I think it's going to be less.
Anyway, I appreciate it, again, bringing ideas, and I think conceptually and strategically it makes sense. Obviously, we just have to figure out the allocation of that work. There's a lot of pain coming down in the commercial real estate market, in pockets, and when there's pain, there's Baron Rothschild, agents during the French Revolution, buy when there's blood in the streets, So I think there'll be some blood in the streets in the next couple of years, and if we can benefit from that, I'm all in favor of that. So thank you for that.
So maybe if it's all right, the next time I'll bring a bit more information on the closed end, kind of circle around the conversation, and then at that point, see what we think. Right. Again, I don't think there's anything immediate that needs to be done. It's sort of getting ready for the next 2-3 years, which is probably going to be more opportunistic.
Thank you. Anything else? We got the calendar year. Any information?
Yeah, we wanted to prepare this, and John, you weren't here, but I had mentioned that the reason we're getting it to you so early is because the Finance Committee had requested a joint meeting with this committee. And, my take on that is that, it's fine if we want to try to arrange a special joint meeting, but I'd like to present them with this schedule and see if they would not rather just attend one of the already scheduled PRC meetings. Because they're talking about the first quarter of 2023, and although we don't have a January meeting, we do have February, March, and if they just showed up at one of these meetings, then we can call that their joint meeting.
And I am in favor of that. We're all very busy, and as are the commissioners. I get that, but it's if we were to have a meeting here, they can arrange a schedule to attend.
And the clerk's office did email me asking about some January dates, and I responded, let's just wait until we get the 2023 calendar set and see if any of those dates work.
I would find it entertaining to see Fred Martin fencing with our commissioners on February 23rd. That'd be a very interesting meeting.
See if we can arrange that.
Okay, so these are all Thursdays, I haven't looked. These are, we've gone.
Except for November and December.
Do you want us to then
Say that again, what was your
make a motion to, I'll make a motion, we approve the meeting
Second.
agenda?
I think November, December.
But they're still Thursdays, they're just
Okay,
earlier.
earlier Thursdays, all right.
Okay.
And William,
Motion,
can you
second,
send
all in
out
favor?
I
Outlook
second.
invitations and we can just kind of click it and add those into the?
Yeah, we'll work on getting those sent out
That'd be
next
great.
week.
Okay. Public comment, any? Your first comment is Pat, right?
Pat, you're public today.
Yeah, you're public. Any more member comment? And our next meeting's an oddball, because it's November 8th,
Oh, is that,
Election Day.
it is, right?
Yeah.
Okay.
November 9th.
Says
Oh, I'm sorry, I'm looking at that. Never mind.
You're looking at,
That's next year.
I'm looking at
You're a year
This year
ahead.
it's on election day?
Yeah,
What fun.
Which is a Tuesday.
It's Tuesday, November 8th.
Now, just a little question for the group, that we have, Loomis is the manager scheduled there. We're taking a sizable chunk of their portfolio. Does that change your thought process for having them come in or not? I mean, ultimately, I think it's probably helpful to get an update on fixed income markets, where rates are and such, but it's just the timing is gonna be a little bit,
I don't gonna be.
You're taking
annoying
before or
for us.
after?
perhaps.
Before or after the
When
meeting?
you say large chunk, I mean, what portion of their portfolio, I mean, half
Probably
of what
20
they?
million.
3/4.
20 of their 26?
Three quarters of it?
That's a large portion.
Well, the whole intent
It's
of
two-thirds.
the amount we left in fixed was to be
To
able
do
to take
this,
it
sure,
for this.
yeah.
And the idea is that if we see some recovery in the next 6 to 12 months in equities,
We'll move some
we
back.
refund it back.
Absolutely.
Yeah.
I'd like to hear what they have to say, so.
Okay.
Yeah.
If you think they'll right with it. It's nothing personal.
And I'll-
It's just business.
And I'll,
It's
Yeah, that never goes over very big. No.
Okay.
Maybe just give them the heads up.
right, oh yeah. Well, then I'll explain the idea of the withdrawal and why it's happening the way it is, and so.
Just tell them if they come here and sell us, they might get more money. You never
Yeah,
know.
Okay. A motion to adjourn?
So moved.
Second.
All in favor?
I like someone running the meeting, you did a good job. You should